the things that we have done over the course of the CARES Act. This thing was 880 pages. We were so fortunate to have just such an amazing team to be able to divvy up different pieces of this and spread it out. Larry, for those of you who haven't had the chance to be able to work with him, Larry is just a great asset in addition to our consulting team. In addition to being a CPA and spending some time at the Big Four, he spent much of his career also as CFA, which is, we've talked about that over the years, an amazing background, basically smarter than the average bear, right? But he has spent most of his career in banking in a variety of different roles, CFO, leadership of a couple different savings and loans, as well as bank, and some portfolio work over the years. So has a really great perspective when it comes to the financial institution side of this bill. And so as we were divvying out, we said, well, obviously Larry needs to be the one that is focused on banking. So Larry, thank you so much for taking this and doing all the heavy lifting. A lot of great conversations over the last week or so as we've been developing all this. I mean, I cannot believe it's actually not even really, I guess we were talking about it a week ago, but this bill passed Friday. And today is Wednesday. So to put this in perspective, I mean, just a huge amount of work. Thank you, Larry. And so I'm going to pass it off to you. Do you mind starting to kind of run us through this PPP loan process?
Sure will, CJ. Thanks for that nice introduction. The CARES Act provides for this very nice loan program for small businesses called the Paycheck Protection Loan Program. It's generally available to businesses with fewer than 500 employees. And eligibility has been also expanded to 501c3 non-for-profit organizations, veterans organizations, and tribal businesses. And something the SBA has not done in the past, they've extended these loans to sole proprietors, so loans can be made to non-entities, to individuals, rather than to an entity. The loan is extremely attractive because the terms are nice in and of themselves, but also these loans are potentially forgivable. So the loan amount that's available to our clients will be 2.5 times their average monthly payroll costs incurred over calendar year 2019, with the loan amount capped at $10 million. So this is a source of funding for many of our clients who currently have no other sources of funding, given the fact that we're in this tremendous economic downturn and banks are reluctant, will be reluctant to lend additional funds.
That's great. And Larry, one of the interesting things, whereas the bill specifically said, we may get into this a little bit later, but basically looked at the 1-year period going back from obtaining the loan, looks like we might have some fresh guidance out there that says it's really going to in many circumstances, might just be the 2019 payroll, which makes it a little bit easier for our clients.
Right. On Tuesday, March 31st, yesterday, the Treasury came out with the decision that they will use the 12 months, the calendar year 2019 is the 12 months. So that makes substantiating the payroll costs a lot easier for our clients. They'll be able to refer back to filed payroll tax returns and perhaps financial statements that have been already prepared for purposes of gaining their health insurance and retirement costs. So it's made it a lot easier to be calendar 19.
That's great. All right. So give us some details on these loans and some of their characteristics, Larry, if you don't mind.
Yeah, these loans are really, really attractive. And I've told a number of clients that there's really 2 decisions that they need to make. One is whether or not they want to seek the loan or get the loan. And secondly, whether or not they want to meet their qualifications and criteria to get forgiveness. So the first decision point we think is pretty easy in almost every case. We think it's going to be beneficial for the client to seek out and get the loan. The loan's extremely attractive. The interest rate will be 4% per annum or less, and the loan will be unsecured, non-recourse with no personal guarantees. For at least the first 6 months of the loan, there'll be no payments. And then for any portion of the loan that is not forgiven, it becomes a 10-year loan. So this is, even in normal times, this would be an extremely attractive loan. But in the current economic environment, this is just a really, really attractive offer. And if you can get the loan, we think in most cases, in nearly every case, it would be appropriate to get it.
That's exactly right, Larry. All right, so what can we use the proceeds of the loan for?
So once you've determined the loan amount, and when applying for the loan, you're going to have to represent that you're going to use the proceeds for qualifying costs incurred during the coverage period. Now, for this purpose, the coverage period is the period between February 15th and June 30th of 2020. And the loan proceeds can be used for all the payroll costs we just talked about, health care benefits, interest on mortgage loans incurred before February 15th, rent, utilities, and interest on other debts incurred prior to February 15th, 2020. And then for this purpose, the term utilities is pretty broadly defined as it also includes telephone and internet service. So all of these expenses are those that you can use the loan for. So here's a detailed list of what is included in payroll costs, and that's going to be, as you might expect, there's salaries, wages, and commissions, cash tips if you're in that kind of a business, subject to additional guidance to come from the SBA, vacations and leave, even severance pay, health insurance, retirement benefits, your state and local taxes on compensation, primarily your unemployment tax, not federal taxes. And then this is also unique in that you're going to be able to include the self-employment income of a sole proprietor or partner up to $100,000. So very common here in Tennessee, where we have a lot of single member LLCs. They have a large payroll, but also the owner of the business or the owners of the business. Their self-employment income is going to be included in payroll cost for calendar 2019, limited to $100,000 per person.
And it's interesting, Larry, there's been some kind of questions around, what all is going to be included in here, and specifically when it comes to these earnings subject to SE and partners that are either receiving guaranteed payments or allocations of income, especially in the post-QBI world. But although we're waiting for some really, more clear guidance, the anticipation at this point is that is going to be included and added. So, instance, somebody had, a couple $100,000 worth of regular wages that are paid out, and then they made $100,000 or more, then $100,000 would be eligible to add to those wages or payroll costs, I should say, as defined above for the prior period.
I think that's correct. And for a sole proprietor, it's going to be their Schedule C income. And if you're a partner and you're actively engaged in management of the partnership, I believe it's going to be your distributive share on Schedule K1, in addition to your guaranteed payments. And then again, all capped at $100,000 per year.
That's right. So, in essence, basically on that K1, what we would normally look down there and say earnings subject to SE, that's probably the number that we're looking for.
Correct.
So what does it not include, Larry?
Yeah, what's not going to be included in payroll cost is any compensation to an individual employee in excess of $100,000. This is kind of consistent with the objective of the bill, and that is to help rank and file employees, people of middle income, get over this financial crisis. Federal payroll taxes are not going to be included in payroll costs. Any compensation to an employee who resides outside the United States. And then any of your paid sick leave or family leave under the Family First Act, for which you're going to get a 100% payroll tax credit, that cannot be included in payroll costs. Since we're using calendar 2019 wages, this likely will not become a factor because the FFCRA is not effective until April 1st.
Absolutely. And that was one of the clarifying points that kind of helped out with that, because otherwise, if we were having to deal with, especially now that April 1's hit and these last, those last two portions from this previous slide here, the paid sick leave and the expanded Family Medical Leave Act, we would have had to start commingling and doing a lot more calculations. So that guidance that came in that lets us look at 2019 as long as the company was around, that's a nice change there for us.
Oh, absolutely. So I anticipate that many many clients won't be applying and many banks won't be ready to apply until May. So it would have been much more of an administrative nightmare to try to get 12 months ended at the end of March or at the end of April instead of just taking calendar 19.
That's right. And so, Larry, so, everybody, these are, everybody's lining up for these things, obviously. So what is the process to get one, and what are your thoughts around that?
So the CARES Act provides for and anticipates that the PPP loans are going to be processed through and obtained through your local bank or credit union. You are not going to apply for these loans through the Small Business Administration or through the federal government. You're going to go directly to your bank or your credit union, and you're going to apply through them. One of the challenges the banking industry is going to have is, as we're advising all of our clients, it's get out there and get your PPP loan. We think it's a great deal. There's going to be millions of small business. Every small business in the country is going to want to get one of these. The banks are telling us they won't be ready to process until the end of April, and the program ends June 30th. So there's just going to be a tidal wave of applications coming into the banks, and it's going to be a major undertaking for them to get all of these loan applications processed in the 7 or 8 weeks or 9 weeks that they're going to be readily available. The other concern that a lot of people have raised at this point is whether or not the congressional appropriation is large enough. $349 billion has been appropriated for this program, but I've seen some estimates that the demand for this loan is as high as $1.2 trillion, or 3 or 4 times greater than the amount that's been appropriated. So knowing that, and that's a potential risk, I guess our advice to clients will be apply sooner instead of later.
That's exactly
now, we've been
right,
informed. Yeah, we've been informed that banks may begin accepting loan applications as early as Friday, April 3rd, this coming Friday. And for sole proprietors and independent contractors, banks may begin accepting applications the following Friday, April 10th. Now, we've talked to several bankers, and at this point, it doesn't appear that anybody is prepared to accept applications, but they're authorized to accept applications on April 3rd.
And, basically the federal government's out there touting these, which is to say that they're hearing one thing from one source, but then the reality of it is this deluge, the lack of clarity, all these different things are going to result in delayed processing. It is a wild ride that is ahead for the bankers for sure. And we'll get into now, why is it, so why is this just so crazy? Not only are there no guarantees like we talked about earlier, from the borrower perspective, obviously there is a guarantee. It's the full force and credit of the United States of America, which, doesn't get much better and has a good yield on it at 4%. But it's the forgiveness aspect that is so attractive, right, Larry?
Right. So another provision of the bill provides for the forgiveness of these loans, and it's really quite attractive. So we have another covered period here in this provision, this part of the CARES Act, which is the 8-week period after the borrower gets the loan. And so the portion of the loan that can be forgiven is first determined by tallying all of these costs in that 8-week period. And it's a similar list with the 5th one missing. It's payroll costs, interest on mortgages, rent, and utilities. So you sum that up, and that portion of your loan is eligible for forgiveness. Now, one thing that's really attractive is any amount of the PPP loan that is forgiven is not going to be income under Section 108 of the Internal Revenue Code. So that's really attractive. But a caveat, there is a provision in the CARES Act which allows for a payroll tax credit and a payroll tax deferral. And if you do have PPP loan forgiven, you won't be eligible for those credits. However, those credits are quite a bit, the economic value of those credits are much less than the forgiveness of a PPP loan.
That's exactly right. So obviously it'd be great if we could get the full amount. We'll talk a little bit about what that means, but for basically those payroll costs that are used during the 8-week period. But there's a couple of potential reductions.
Right. And we've run the math on this for a couple of our clients, and it's unlikely that anyone's going to get a 100% forgiveness. You could get darn close, but more likely than not, if you retain your employees, your forgiveness is going to be likely somewhere between 75 and 100% of your loan amount, because the forgiveness amount is going to be reduced by two factors. One will be the average number of full-time equivalent employees you had during a base period as compared to the 8-week covered period. And then secondly, there's going to be a reduction to the extent that you reduce the wages of your rank and file employees. So this is how the first portion of that test works, the first reduction phase. You're going to take those eligible costs that are allowed for forgiveness, and you're going to multiply them by a fraction, which is the average number of full-time employees during that 8-week covered period, divided by a denominator of full-time equivalent employees during a base period. And the borrower gets to choose between one of two alternating base periods. So one of those, the borrower will be allowed to choose between the base period that runs from February 15 of 19 to June 30th, or from January 1st of 20 to February 29th of 20. The applicant can choose either one. Now, if you run through the math, what you'll want to do is choose the base period that results in the smallest full-time equivalent employee average, because that will increase the amount of your loan forgiveness. So for a rapidly growing business, you might have significantly more employees in 2020 than you had in 19. And that's very likely to result in little or no loan reduction for the FTE test.
And Larry, sorry, we're getting a duo notice here that we need to make sure. Got a duo, right? Stay calm,
yeah.
Stay calm and duo on, right? But let me get back here to the phone. Actually, this is an iPhone. Help me out here, Ben. Get me back to the phone screen so I can mute myself here in a second. But for these loans, on the application, there's a box that says number of employees. What are some thoughts you have around that process, Larry?
Yeah, for purposes of determining the loan amount, applying for the loan, the bank really doesn't need the number of employees. It doesn't determine anything. But, at the end of that 8-week period, when you come back and you apply for forgiveness, I think you want to put on your loan application the base amount of employees that you're going to use. So what I'm encouraging clients to do now is run through these calculations before you apply for the loan and put that base number of full-time equivalent employees on your application as the number of jobs. That's going to save you from the problem. If you put down the number of jobs is 40 on your application, and then you come back, 10 weeks later and say, well, my base number is 25, it might complicate the process of getting the forgiveness versus putting 25 on your application to begin with. So I would take the extra time if you can and do those calculations and make your optimal selection before you apply for the loan.
Yeah, that's a great perspective right there, Larry. And so the second reduction, so we have the reduction for the workforce, but then we also have one for salary and wages.
Right. So the second test is they're going to take a look at each one of your employees during that covered period. And to the extent the employee has had a 25% or more reduction in his or her salary versus the first quarter of 2020, you're going to have a dollar for dollar reduction off of your forgiveness. So by way of example, let's say you had an employee that was making $1,000 a week, Jill, and during the 8-week testing period, she is paid $650 a week. then your reduction is going to be $100 per week. Now, we believe there's a drafting error in the CARES Act where this is done on a quarterly basis. So go back to my example. If Jill was paid $10,000 in the first quarter, and she is making, we would take $10,000 and multiply that by 75%. And if she makes less than $7,500, there would be a dollar for dollar reduction in the forgiveness. Now, because they're using a full quarter, 8 weeks is not 75% of a quarter, it's about 60% of a quarter. So it could be, and we'll have to wait for additional clarification from SBA, that you could continue to pay the employee the exact same amount you were paying them in the first quarter, but because you're only going to pay them 60% of their wages in an 8-week period, you might have a reduction for every employee that you have. But again, we don't know whether this was a drafting error or this is what the Congress intended when they wrote the provision the way they did.
We sure hope it's a drafting error, because otherwise we're going to end up with a lot of clients with some significant reduction in the forgiveness amount. And maybe, you know, as we talk about kind of what that documentation looks like, and we'll close out with that, and then maybe give some thoughts here about what it actually means to why we might not pursue forgiveness.
Right. So we talked to a number of clients, and their business is closed with no revenue, or you know, they've seen their revenue fall so precipitously that there's virtually nothing coming in the door. And we've questioned, or we've kind of talked about the idea of what is the best use of the loan proceeds. If you get a PPP loan, what's the best use of the loan proceeds? Are you really better off to take that money and use it for payroll, or would you be better off to use that money for rent, mortgage interest, and utilities, forego the forgiveness, furlough your employees and let them go on the enhanced unemployment benefits, which in many cases is going to be equal to or even greater than the wages they're currently earning? Because at the end of all of this, if the employer goes out and gets a PPP loan and then turns around and uses all of the proceeds to pay his or her employees, even if they get 100% forgiveness, the employer has no money. They've borrowed it all, they've got it all forgiven, it's all spent, they've got no money. They're still going to owe their mortgage interest, their rent, their utilities. So there's a line of thought now that perhaps for many businesses, particularly those that have been closed or seen a substantial reduction in their revenue, why not furlough your employees, let them get the enhanced unemployment, take the PPP loan, pay mortgage interest, rent, and utilities, and simply forego the forgiveness. And I think for many of our clients, that's going to be the more optimal choice for them.
Absolutely. You know, and one of the things, whether it's foregoing because of the reduced calculation in the forgiveness, but there is still some forgiveness that can transpire because, you know, although this wasn't in the bill, we have the 75-25% that seems to have shown up in a couple of places, right, Larry?
Right. In most cases, the borrower employer is going to have not all of the loan forgiven. It's only going to be in a rare case when you get, you know, nearly 100% of the loan amount forgiven. So I think the borrower's employers have to come into this with the idea that not all of their loan is going to be forgiven.
That's right. And, you know, we've got some additional guidance now that basically says, you know, we're only going to forgive up to 25% for the non-payroll costs. And so that was an interesting thing that got added through this last couple of days since they passed the bill. That really wasn't a part of the bill at all, but it seems like that's the direction that the administration is taking on the forgiveness amount.
Yeah, I've seen that on a couple of the agencies' web pages. I'm not sure whether that is just their estimation of where most borrowers will come out after they do the calculation, or whether they're really putting in place some kind of a hard 75% cap. We'll have to wait for additional guidance to come out to really determine that.
That's exactly right, Larry. And, you know, I love what you've talked about here around seek forgiveness or not, the reality of it is, we've said it once, we'll say it a bunch today, but is that our clients really need to staff to the revenues that they are receiving. They need to basically not be focused on trying to maximize loan forgiveness, but need to be focused on maximizing liquidity. You did a great job in drafting our liquidity stance that we passed out to clients in kind of version 1 of the Relief Consulting Toolkit. This liquidity crunch, it's so much more important to have these funds to keep the business alive and let unemployment take care of employees when needed, so that when we do come out of this prayerfully soon, that the business is sound and ready to revamp and fire things back up and be a huge productive member of the economy that was just blowing and going before all this transpired.
Yeah, I think that's right, CJ. I think most employees would say they'd much rather go on unemployment, even if it's at a slightly reduced compensation than they were getting, and be able to go back to a sustainable, vibrant employer 3 weeks, 6 weeks, 4 weeks from now, instead of having their employer run out of cash and go bankrupt. So, there is a choice to make for our clients as to the best use of the proceeds of the PPP loan.
Well said, Larry. So what's in it for the banks?
So yeah, everyone might be wondering, well, why would the banks do this? Because there's no origination fee to be paid by the borrower. Well, the banks are going to be paid directly by the Small Business Administration, and they're going to get compensated for an origination amount between 1% and 5% of the loan amount. So with a $2 million loan, the bank will get 1% or $20,000 to process the loan. The bank will also get a rate of interest of up to 4%. We believe the banks are going to charge that 4%. The loan is 100% guaranteed by the Small Business Administration. And in most cases, the Small Business Administration will purchase the loan, or the loan will be saleable into the secondary market if the bank wants to raise liquidity. And then finally, the bank's going to get some nice bank capital characteristics for these loans in a exemption from troubled debt restructuring disclosures.
Absolutely, and we're anticipating there's probably going to be a pretty nice secondary market for these. I mean, where else can you get we talked about those folks who are not going to, most people will not experience full forgiveness, very rare. Even for those that maybe it doesn't make sense to even have, to really try and preserve these funds to keep the business alive so that we do get out of this and are ready to ramp back up, et cetera. So, in most scenarios, we're going to see some level of forgiveness, partial forgiveness, even in the 25% conversation we had previously around things like rent, utilities, et cetera, in addition to the payroll cost definition. And there will be some payroll costs, but that leftover, it gets flipped to these 10-year 4% loans. I mean, that's a pretty nice, fully insured by the government return in today's market versus treasuries, right?
Absolutely. So the portion of these loans that are not forgiven are likely going to be packaged into asset-backed securities and sold into the secondary market. And in an environment today when the 10-year treasury is about 0.6%, here you'll have an asset that's yielding 4% with a full faith of the U.S. government guarantee. So these loans, once they're pooled, will probably sell for a very significant premium, probably approaching 110% of the principal amount.
Yeah, that's amazing. And so as the banks start getting this, we've got a little copy of the application that has popped up here on the SBA website. Pretty simple, huh, Larry?
Yeah, the form of the application is quite simple. It's a 2-page application. There's only 3 calculated amounts that need to be put on this: the average monthly payroll cost, that amount times 2.5, and then the number of jobs. The remainder of the application is pretty standard stuff: the name of the employer, their address, phone number, their EIN, and then a number of representations that the business is engaged in legal activities and hasn't done some bad behaviors in the past. What will go along with this, though, is some of the supporting documentation. So you need to be prepared to provide your banker with your 2019 payroll tax returns. That's going to be your Form 941 for each quarter, the end of year W-3 and W-2s, perhaps your Tennessee or other state unemployment quarterly filings, and a schedule detailing your payroll costs and all your other qualifying costs, retirement benefits, health insurance, other qualifying payroll costs that you're going to use to arrive at that average monthly payroll cost, which will be multiplied by the 2.5 times. So knowing before you go to apply with your bank that the bank is going to be deluged with these applications, you want to make sure that you've got all of your everything lined up and well organized, so you make the job of your banker easy, so your application gets pushed to the top of the pile or closer to the top of the pile.
And that's one of the big things we've been talking about a lot, is just given this demand. We know that a lot of banks have already said publicly that they're only going to process these applications for pre-existing customers of the bank. We want this application to be as clean and simple to process for the banks as possible, because of the limitation, as you mentioned earlier, around the funding versus the demand for the funding, and being just such disparate numbers.
Right, and I think that's really important. So be prepared. I think your Blankenship CPA can help you if you need to prepare a schedule substantiating your payroll cost to be used on the application. Reach out and get assistance, and then make sure that you've got available, and it should be pretty easy to obtain, your 2019 payroll tax returns, so that you can provide those to your banker along with your application.
That's right. That schedule of payroll costs, like we talked about earlier, very important. And maybe just kind of this last, Larry, you and I spent a lot of time on Monday of this week talking about the EIDL loans, the IDL loans, and specifically their interplay with the PPP, because we know we have these EIDL loans out here. There's $10,000 that basically appears to be not subject to the repayment of the normal EIDL loan provisions. These are economic injury disaster loans. But one of the things that I think our perspective is, yes, we feel like there's a $10,000 benefit out there. We're not seeing an end to the EIDL program that is a date certain at this point. Larry, have you come across anything that shows a date certain end?
I haven't seen a date certain end, and we have come across this. The entire country has been designated a disaster area for COVID-19 crisis, but also here in Middle Tennessee, we are still dealing with the crisis and the fallout from the tornadoes that hit back on March 3rd. So we have a number of clients who may have already gotten one of these, or they're contemplating applying for one. There's also a $10,000 advance on these loans that can be obtained online from the SBA. We're recommending to our clients not to apply for this loan because it may muddy the application process for the PPP loan, number one. And number two is, remember in our calculations in terms of how much forgiveness you're entitled to, you have to be able to represent in that 8-week testing period after you get the loan that you've dispersed the loan proceeds for the qualifying costs, payroll costs, rent, mortgage interest, and utilities. Well, you're not allowed to, so to speak, double dip. So if you're telling the SBA that you're using your EIDL loan proceeds to pay for these costs, you can't also then use these same costs for getting loan forgiveness on your PPP loan. So we think the best course of action at this time is to wait, not to apply for an EIDL loan until you have applied for and obtained your PPP loan, and then even gone through the 8-week covered period process, identify your forgivable cost, even submit your loan forgiveness application to your bank before you consider going forward with an EIDL loan.
That's right, Larry, because ultimately the EIDL loans really are designed for those who have incurred very specific economic injury as a result. So, some of the certifications, the process is a little different than the PPP, whereas there's just a presumption in the PPP. The other aspect of it that's important is we go to say, well, why would I, pass on the $10,000 free money? One, we're not sure, right? But that program appears as though it's going to last for a long time. And so in light of that, we just, you don't want to do anything to jeopardize the PPP. And then we want to be as easy as possible. The applications are going to be a deluge for the bankers. There's a box on the application that specifically says, have you applied for an EIDL loan? And the provision, this is important to understand, the provision that's out there for the PPP loan actually specifically states that the EIDL loans that have been funded are going to get rolled into the PPP loan. And there is no guidance at all on how any of that stuff's going to work. And so we know that they are integrated in some way, shape, form, or fashion. We don't know what that process is going to look like. And because the PPP loan is just such a rich thing, and the EIDL loans are great. Don't misunderstand me. What is it, 2.75 for nonprofits, 3.75 interest rates for for-profits, and up to a 30-year term?
Right. Although the EIDL loans, above $25,000, you've got to provide collateral, which is, unlike the PPP loan, which is an uncollateralized loan. So, but I think you're right, CJ. I think it's more prudent to wait for additional guidance from the federal agencies as to how they're going to treat the interplay between the PPP loans and the EIDL loans before you apply for an EIDL loan. The process for an EIDL loan beyond the $10,000 advance is not something that's going to happen quickly. So I think the clients are better focused on getting the PPP loan, where applications are going to start being accepted, if not this Friday, certainly in the next couple of weeks.
That's right, Larry. And just by way of background, get the PPP, get it filed, get in line, see if you can get the funds, and then roll into the EIDL process. And even if you decide to get in that before you've expended those funds, like Larry said, I think definitely you've got to make sure to, if you're going to expend the funds and potentially be eligible for forgiveness, you don't want to muddy those waters with the EIDL dollars. But as you get into that EIDL process, you don't have to take the funds. Obviously, you take the $10,000 up front. There's a simple box that you check to ask for that during the application process. But once those funds do come available in the future, you don't have to necessarily take them once the loan is offered. But you got to be careful, because I think for our clients especially, and this is one of the things we're talking to our team about, is we don't want to inadvertently, if that EIDL loan, for instance, came back and provided funding for 6 or 8 months of operations, and a client took that funding, all of a sudden now they're not able to potentially experience the full benefit of the forgiveness for the PPP, providing, of course, that they have staff to the revenue levels like we've talked about today. But it is interesting times, isn't it, Larry? Lots of pieces moving without a lot of insight into all the details.
That's exactly right. The guidance continues to come out from the federal agencies on a daily basis. I'm actually visiting the websites throughout the day, because both the SBA and the Treasury are updating their web pages throughout the day with additional information. So we're trying to stay on top of that, and we're passing that as quickly as we get it.
Well, very good. Well, I just want to thank you so much, Larry, for your time with this. And thank you for studying this and going so in depth, bringing all your banking experience. It's such a pleasure to have you part of the consultant team here at Blankenship. And thank you. So with that, we'll move on to our next.